Good morning, traders. We have quite the market sell-off overnight. Trump announced his tariff plans, and the market has sold off about 200 S&P 500 points. Boy, somebody's going to lose their job. I'm going to give you the trading game plan today. I had promised to do short videos that were about 2 or 3 minutes long. I can't do that today. We got a huge market sell-off. And look at this early anticipation of what Trump was going to say yesterday. That was about an 80-point S&P rally. Somebody's going to get fired. As soon as he started to reveal his plan, the bottom fell out, and you can see how the S&P 500 fell about 200 points from its close yesterday. So we've got a big down open today. I know a lot of you are going to be wondering, what do I do now? How do I trade this? So we're going to go through, we're going to do some analysis. We're going to take a look at what's happened historically and what I believe is going to happen today. So let's zoom out to a daily chart, and let's go all the way back to our previous bearish market conditions, which was in 2022. We traded the hell out of that very nicely. So you get this herky-jerky movement when the market's starting to establish its high, and we had the Fed threatening to raise interest rates faster than ever before. Whoa, that's going to crash the economy. Nothing had happened, mind you. Okay, they were talking about raising interest rates to combat inflation. It had gotten out of hand. So you get this first crackdown like this, pretty similar to what we've had right now. And you had major upward sloping trend lines that were breached. We were trading below the 200-day moving average, just like we had done last week. Then you get this nice little relief rally because, oh, hey, the world hasn't fallen apart yet, even though the Fed is going to raise interest rates. So the market bounces on this news and it finds resistance at the 100-day moving average. Then you get this next big leg down. And right here, you have a horizontal support level that is breached, and it's breached considerably. That's kind of where we're at right now. And you're also going to see these violent bounces. How can I be so sure? Because the tariffs, in many cases, aren't going to be implemented for a month or so. We aren't going to know what the true impact is on economic activity for probably 6, 8, 10 months. We're not going to know what the impact of the inflation is. And we know that the market has a 100-year bull rally going on. So there's always a bid to the market. There is always a bid to the market. You've got corporate buybacks happening, although right now there are no corporate buybacks because we're in that dark blackout period before they announce earnings. But there will be bounces. This is a big news event, okay? This is not something that's going to be here today, gone tomorrow. This is going to linger and linger and linger, and it's going to persist for a long time, perhaps throughout Trump's presidency. Now, the one thing that I will say is that it's subject to change. So in some cases, Trump is using tariffs for punitive reasons because he wants to get change out of the countries that he's putting these tariffs on. In other cases, they're reciprocal, and he's simply looking for a way to generate income and to get them to take off some of their restrictions so that U.S. companies can compete abroad. Whatever the reason, you know, people, I like tariffs, I hate tariffs, tariffs are good, tariffs are bad. Who cares? Okay? It doesn't matter because all that really matters is price. And if you followed my analysis, then you know that we've been short. And we've been actually flat since December, early December. So you should be in a cash position as far as your longer term swing trades in your portfolio. But we are going to get bounces like this and shocks, especially after big drops. So that's the point that I wanted to drill home. And then you see that off of these bounces, we hit resistance at the major moving averages. All the major moving averages are flattening out and they're starting to roll over. That is a bearish sign. Okay, so once we get these bounces, this is where you want to be short. You do not want to be shorting the open today. And we're going to get into that. That is a horrible trade. That is an awful trade. Your risk reward is absolutely terrible if you go in and short the market this morning. But I'm going to tell you also that the market is probably going to continue to go lower. Here you can see that once we got through that support, you did have a very long bullish engulfing candle off of that low. It wasn't an engulfing candle, but it was a dang long green candle. Gap down, open on the low, rally the entire day. Is that what we're going to see today? I doubt it. This is some pretty heavy news, and we're still getting reactions globally to what these tariffs are going to actually mean and what type of retaliation the U.S. is going to see by imposing these tariffs. So I don't believe we're going to see this because, again, this is all supposition. Oh, the Fed's going to raise interest rates and the economy's going to fall apart. But hey, the jobs number was actually pretty good. So they rallied the market back. There was no second shoe to drop in 2022. It was all supposition, like I say, that, oh, the market's going to fall apart because higher interest rates are going to strangle the market. But there was really no proof of it because we continued to have economic growth. And so this little bear market didn't last quite as long. But if we fast forward, we can see that the market rallied considerably. It ran out of gas right up in here. Okay, this is early December. This is where I told all of you to go to cash for longer term basis. I did not like the setup that I saw coming, but it wasn't just this price point. It's everything that freaking came before it told me this market is topping out right now. So go to cash. It's still too early to short, and we need that technical confirmation. And we got little spats of pullbacks in here. And then we finally cracked down, broke some upward sloping trend lines, broke some major moving averages. Awesome. Now let's see what happens. Well, we got follow through. Hey, we made it through the 200-day moving average and we spent time below it. Been watching my videos for the last few months. You know where I stand. I've given you the play-by-play on this. So that was a sign that the selling pressure is heavy. We have a meager little bounce and an instant rejection. Finally, on a longer term swing basis, I have all the technical confirmation I need to get short. So you get short in here, you get a doji, you add in here, and now you're in a great position. You can see the indication right now is 546 roughly for SPY, which will be well below that horizontal support level and well below the low that we put in on Monday. So big gap down like this, what am I expecting to see? This is probably going to be a gap and go lower. So the news is heavy. Global markets are down about 2% right now on average. So everybody's kind of reeling after this announcement. And it was more substantial than everyone thought. And for some reason, everyone has discounted the tariffs and the fact that Trump was actually going to follow through with what he said, even though he ran on this. For the last year, we've known that when he took office, he was going to be putting higher tariffs in. So this shouldn't be a shock to the market, but it is. So now what do we do? How do we deal with this? So first of all, we're going to get a pretty deep drop in here. If I had to guess how far the S&P might possibly move down before it finds support, I would estimate somewhere around the 525 level. Is it going to get there today? No, it's not going to get anywhere close to that today. This is going to be a process. And the reason I say that is if you take the height of this bounce, which is about 25 S&P points, and if you subtract it from 550, you get 525. Does that mean that I hold on to my short positions through thick and thin until we get to 525? now. It's just an estimate of how far the market might fall, and there are going to be lots of pops, lots of bounces in here. Why? Why, Pete? Why? Because we don't know how the tariffs are going to impact the economy, and there's always a bid, and there are always buyers around. Here's the really big problem, though, with the overall market. The macroeconomic landscape has been deteriorating for a year and a half. That's the big problem. It's not the tariffs. It's the fact that global economic growth in Asia and in Europe has been faltering. Now, we can't take China's economic releases at face value because they're fake, okay? They're not real. I've seen estimates that their actual GDP could be flat to 1%. I consider those sources reliable, and there are other metrics that you can use, i.e. companies that are generating revenues in China, for instance, Starbucks, and they're showing dramatic same-store decreases in China, 14%. So it tells you that consumers have been cutting back. U.S. corporations have to report accurately, so they're a good litmus test. You can look at Las Vegas Sands. You can look at Wynn Resorts. Those companies have to abide by our accounting procedures, and the guidance that they're giving is quite good. It's very revealing versus the numbers that China puts out. They've got a huge issue. And when you take the second largest economy out of the global picture, okay, this has been the growth engine for 3 decades. You take that out, where's the growth going to come from? What other country is growing like that? India is about 10% of global GDP growth. Yes, they've been growing nicely recently, but not enough to offset what's happening in China. So you've got that issue. You also have a lot of U.S. debt that has to be rolled over this year. $9 trillion of debt. Okay. No problem, right? That's a lot of debt to issue. And what happens when you have a huge supply of debt is that you're putting downward pressure on bonds, which makes the yields go higher. So yields are going to stay elevated. If you start introducing tariffs that piss everybody off, who do you think is going to be buying our bonds? China has been a net seller of our bonds. So they are not going to be buying any of those bonds, and they're going to retaliate. They're going to protest, and that's one way that they're going to be able to show it. So you've got China actually reducing their U.S. holdings. Their U.S. holdings are at their lowest level in over a decade. You've got Japan, who's just been hit hard with tariffs from the U.S. They're our largest debt holder. You think they're going to be super excited to buy bonds? No, they're not going to be. So interest rates are going to remain elevated. You've got consumers who have already been pulling back. How do I know that? We've seen it in consumer confidence. We've seen it in consumer sentiment. We've seen it from all of the retailers who have been reporting earnings that consumers are pulling back. We also know that credit card delinquencies are on the rise right now. So that's not a good sign from a credit standpoint. It's certainly not a good sign from a consumption standpoint or an economic growth standpoint. We have the Federal Reserve looking at a minus 2.5% GDP this quarter, Q1. Okay, so now we're starting to feel that impact. So don't focus on the tariffs, okay? It's not the tariffs. The tariffs are getting the blame. Are tariffs helping? They're not helping the situation. They're just accelerating the market decline because now everybody's really starting to get worried. You had asset managers with cash levels so low that we haven't seen that since 2010. Okay, well, what does that mean? That means there's no firepower to buy dips because they're all in. And in fact, now once they've seen this market crackdown, they're thinking, uh-oh, maybe I should be in risk off mode. So instead of having net buyers, you've actually got net sellers to reduce risk, and that puts downward pressure on the market. So all of these factors point lower, and that is where your focus needs to be. The market is heading lower. So that's the primary lesson that you have to learn today. Now, the second part of the equation is, okay, so how do I trade it? Market's going lower. How do I trade it? We expect these violent bounces, and that was a 250 point S&P rally. Where do those bounces come from? They come after we have a big, steady drop that happens very quickly. So we're likely to see another leg lower in here, and then there's going to be support. The rubber band's going to get stretched too long, and it's going to snap back. Those snapbacks, that's where you want to short. And you don't want to do it instantly. You want to wait for confirmation that the market has hit resistance. When we did that last week, we poked up above the 200-day moving average briefly. We closed above it 2 days, and then wham, it got rejected hard. All right, this is my entry point for shorts. And I know that this is a good entry point because of what's happened previously on the decline, on heavy volume, and because of this wimpy, crappy little light volume mixed overlapping candle bounce. These are all just programs in there driving the market back after a deeply oversold condition. So I'm looking for the move today to continue to drift lower, and it's not a good time to enter short positions. Okay, well, what should you do? Well, by all means, if you've got shorts on overnight, stick with them. Try and ride them. Try and see what the market does during the first half an hour, first hour. I'm looking for maybe a little bit of an attempt. I mean, this would be the best case scenario for people looking to short today. And there are going to be some opportunities to possibly short, but it would only come in this one scenario. And that would be off of a bounce, and the market tries to get back to 550. How do we want to see it get back to 550? Do we want to see it get back to 550? It has to be a fight. It has to be a struggle. And we had some pretty nice moves yesterday. I'll take off the extended hours right now to show you what we do not want to see. We don't want to see a sell-off like this, and then we don't want to see an instant bounce like this. And this is going to lure in bearish speculators. So they're going to short, and then the market rallies back like this, and they get trapped. And now they've got to cover their short positions, and then you get a move like that. For whatever reason, the market was anticipating that Trump's tariffs were going to be better than feared. And that turned out to be a bad assumption. So what we want to see is a tiny, minuscule little grind back. And I'm going to try and find an example of that type of price action, but it has to be wimpy and just strained, and the market just can't go higher. Like this, something like this. Okay, mixed overlapping candles. Oh, we want to go higher. We want to try and get higher, and the market just can't get into the gap, and then it rolls over, and then you're going to take out the low. You're going to flush out these buyers, and then the market's going to get into a gradual, steady decline. This would be the best case scenario for day trading today. What do you mean? We need to see which stocks are weak relative to the market. And this bounce right here is going to reveal which stocks are truly going to be heading lower all day, because as the market's trying to move higher into the gap, those stocks will be ticking lower. And then as soon as the market hits resistance, you can short those stocks. But without this type of bounce early in the day, risk is elevated, because then you just start this gradual, wimpy little drift lower. And if you join that little drift lower, you run the risk of boom, big 50-point S&P rally that absolutely annihilates you. So joining a down gap and go after a big drop like this is very, very risky. And the rewards do not justify the risk. Why is that? How do I know this? Because I've been doing this for 35 years. What happens is that you're going to see a gradual drift lower. And after we've already sold off 200 S&P points, it's just going to drift lower. And most of the gains are going to be realized probably in the first hour, the first 90 minutes of trading. And then the market's just going to flatline. And it's going to go, holy crap, what was that all about? And you're not going to see much movement. Friday, you'll probably get a little bit of movement, but generally after a big down day, you have a day where the market pauses, it rests, it just digests what the heck has happened. So there's not going to be a lot of opportunity. This is going to be a good time for us to wait and to evaluate and to see what the heck actually happens. And like I said, shorting that drift lower is going to be very risky as far as the overall market is concerned, but there are going to be some stocks that are actually going to tick lower and lower. And the types of patterns that you want to look for on stocks are Lulu, by the way. I always review my previous pick. Oh my gosh, I didn't even do that to start the video off. Too many other things to talk about. I gave you Lulu. That was a pick from my Sunday video right in here. And you can see from the M15, we'll go into that. Geez, I got to take the extended hours off because that's the reveal. Here's the price action Sunday, drift lower, market rally. The last 2 days, what did the stock do? It kept going lower. That was an awesome short. And look what it's doing overnight. Down about 45 points. If you took that Lulu short, good for you. You are going to be making some serious money this morning. Merck was my pick that I gave you on Wednesday. Merck could do okay today. Not run, not rally. It's probably going to sell off a bit, but it did not get the news, the tariff news that it needed. Right now, it looks like pharmaceutical companies are going to be spared because Trump is going to be reviewing the whole FDA approval process, and they're looking to postpone those tariffs because they want to give pharma manufacturers a chance to move their operations to the U.S., and that's going to take time because everything has to happen in accordance with FDA rules and regulations, but they want to bring back production here in the U.S. If for no other reason, just for a security reason, if we ever have a large health issue like we had with COVID, we want to make sure that we're managing that and manufacturing that in the United States. So it looks like pharmaceutical companies are definitely going to be soft in the future, but at least as far as what happened overnight, we're not seeing Merck tank. But it's right about where it was when the video came out yesterday, and that's after a big market rally. So keep an eye on Merck. Could work out, could be a good short, but you're going to have better shorting opportunities elsewhere. Any company that does business in China, like Apple, I think Apple gets about 15% of its revenues from China. You can see, wham, that one's going to hurt. This could also hurt U.S. brands abroad, just in retaliation. For instance, in Europe, we've seen Tesla sales go down dramatically just because of Elon's involvement in the government. I think if I'm correct, Tesla sales were down like 45% month over month a month ago. So it's having an impact. So in any event, there's also that side of it. Any company that is generating a lot of their revenues internationally is going to have more risk exposure than a company that generates most of its revenue domestically. I think that tech companies also, now they're going to sell off today. There's no question. But if it's like Meta, which is really just a social media giant, they don't really manufacture anything. I don't think they're going to be impacted as much. Google, not impacted as much. So try and look at where the greatest impact is going to be in terms of possible tariff retaliation. And all I have to do is look at after hours losers is a search that I run. And you can see these are the names that are getting hit after hours. So what do we do this morning? How do we trade it? First of all, you want to make sure that the stocks that you're shorting have fallen below a technical support level. Was support, now that is resistance. And maybe we could take a look at Lulu as an example, and we'll see where that major moving average was. So let's just use it as an example. So the stock has cracked down below a major technical was support, now resistance level. We've had a market rally the last couple of days, and you can see that. Okay, we had a nice market move higher, and this was actually looking pretty dang bullish. There's your low from 2 days ago, and there's where we closed. So we went from 555 to 565. That was a 100-point rally. What do we want to see weak stocks do in this environment? We want them to bump up against that resistance and not be able to get through it. Even with the big market rally, those stocks can't get off the deck. That is a sign that they want to move lower. So even with the market rally, those stocks are still weak. So if you can find these stocks that are still staying below that technical resistance, that haven't gotten annihilated on the open, those are going to be pretty decent shorts to take. Now, there aren't going to be many of them. And with a market move like this, where we're down 200 S&P points, everything's going to get clobbered. And so you won't be able to distinguish those stocks with real relative weakness until we see a little bit of a market bounce. That little market bounce, our best case scenario that I outlined, that may not happen. And if we don't get that little market rally, we won't be able to see if those stocks are ticking lower. That would be our best case scenario. Then without that, and with the most likely scenario being a gap down and just a gradual tick lower, we aren't able to separate out the fakes from the real McCoys very easily. So today really should be a day when you're not that active. Now, the exception to that would be if you get that nice market drift lower and that tick lower, and your stocks are performing, your shorts are performing, your swing shorts, you're either short overnight or you weren't, okay? It was one of the two. You either had shorts on or you didn't. And right now is not the time to be getting aggressive after a big overnight move like this. This is a time to assess. This is a time to evaluate. By no means, what should you not do? Oh my God. Do not buy this dip. That is the absolute worst thing you could possibly do. Oh my gosh. No, do not buy this dip. You have to let it run its course. There will be a bounce at some point in time. And I've got a couple of stocks that I like, but as soon as I put those stocks out, then I get people who buy them on the open. And then a week later, they're like, what should I do with this? It's not going up, it's going down. That's because the whole market's going down. So I'm not even going to give you any longs, but you will get some longs if you keep watching my videos. I'll put them out there when the timing is right. And there are going to be some stocks that pull back today that really shouldn't be pulling back. Nice stocks that are not exposed to tariffs and that will perform well, and that pullback is going to give us an opportunity. You also want to keep your bullish trades to a minimum if you're trying to play those bounces. And that's a classic mistake that a lot of traders make, is they take their focus off of the big picture and they start zeroing in on, oh, look at this. This is a sell-off. Pete's bullish. He thinks we're going to bounce. We're going to bounce. I'm going to get long. This is going to be a great trade and the market's going to go back to its all-time high. And it never does. In fact, you start focusing on this little bounce here. So you get nice and long. Oh, goody, it's above the 200-day moving average. This is going to work out great. We should get to the 100-day moving average. Blam! See you later. Your focus should have been on not trading this wimpy little bounce in here. It should have been on, hey, the higher it goes, the better my entry point for shorts. All I'm going to do is I'm going to keep searching for my shorts, and I'm going to wait for this bounce to run out of steam, and then I'm going to get in. So when you're trading this bounce and getting long, you are a fool because, and you can hear me call people out for that over the last 2 weeks in my videos. Go watch them. This is where your focus needs to be. And when that drop below the 200-day moving average came, we were shorting and we were adding, and we're in great position. So don't take your eye off of the longer term picture. Right now, the market's going to head down. It's going to keep heading down. And we want to see where that support is eventually established. This drop is also going to tell us how aggressive sellers are. Okay, so is this a massive unload? Are there a lot of people who are finally starting to see that, hey, this is not just a little dip lower that I need to buy? There's some substance to this move. And that's typically how this works, is the first move everyone discounts. The first move after a bullish market, everyone thinks, hey, buy the dip, 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 buy the dip. Well, this one's different because it's longer, steeper, deeper, lasts longer. We're below the major moving averages. Those are the tells that this is a legitimate move and that you should be looking for a short entry on a wimpy bounce. So when you get this crackdown, all the dip buyers in here that didn't know how to read price action, and you get this big move lower here, now all of a sudden the light starts going off. I think I see that there's a trend reversal forming. And so now buyers become less aggressive than they were in the early stages of a trend reversal, and those drops start to gain momentum. Now we've got earnings season coming up. That's going to be a big factor. I believe that's going to be the next catalyst for the market to move lower because they've been coming out and they've been lowering guidance. The companies that have announced in the last month have been lowering guidance. Look at Federal Express, look at Lululemon, just go right down the list and look at the guidance that recent corporations have put out there that have reported in the last few weeks. It's not good. And I think that that's going to be a recurring theme. They're going to be also talking about the impact of tariffs. They're going to be talking about uncertainty. Gee, we don't really know where our revenues are going to come in. So that's going to take time to unfold. Could we see a little bit of maybe a rally before earnings, a little optimism, and then the second shoe drops? Yeah, I think that's probably what's going to happen because this big move down is going to take time to be digested. We'll put the extended hours back up so we can keep that. So I'm looking for a drift lower. I don't know that we get quite to 525 on this move because it's going to get fairly extended. Markets have a tendency to move further than you thought they could. So even though it looks like, oh, we should find support somewhere between 550 and 525, don't think that way. Just see what the price action is today. I'm looking for us to continue to drift lower over the course of the next probably 2 or 3 days. The market will find support. Now we've got earnings season coming up a week from tomorrow. JP Morgan releases, some of the banks release. We're going to be looking at bad loan write-downs. We're going to be looking at credit delinquencies. Interest rates have been higher for longer. What impact is that having on lending? What impact is it going to have on corporate profits? I kind of think banks might be okay yet because the employment numbers have still been fairly steady. But once we get through those bank earnings, then we're going to start getting into tech earnings and some of the other companies. But I think that guidance is going to give us some follow through selling perhaps towards the end of April. So I don't know how much light I've shed on this, except for the fact that you need to be bearish. Your primary thought is don't chase big drops. Big drops, when you are bearish and have bearish positions on, are where you want to be taking profits. So if you see that nice drift lower and you're making a ton of money on your put trades, Lululemon, I'd be taking some of that position off on the open. Heck yeah, 40-point drop. Hello. I'll take at least half of that position off and see what happens the rest of the day. But you're in profit taking mode when you get these big declines. When you get these big declines right in here, you're in profit taking mode. You don't wait for the bounce. You take gains into those big drops. Why? One of the reasons is because option implied volatilities are sky high. You're going to see those options get jacked up in price today. And that benefits anybody that's long puts. So you benefit from the price of the stock dropping and going further into the money. You also benefit from an explosion in option implied volatility. And if you are long puts, you do not hit bids, you place offers and targets out there. Let them come get you because they want what you have. And so, yes, taking profits on some of your shorts today, that would be probably the only real action that you want to be taking. If we get a nice little bounce back up to this 550 level, then we can really line up some shorts, some stocks that are continuing to tick lower. Absolutely. Going to be some good day trades if we get that. But again, the stocks have to have a resistance level close above that they cannot penetrate, and the stocks can't have tanked 5% overnight. And we want to see that nice gradual tick lower on good volume. Then those would be good candidates for us to take, and they can't get off the deck when the market has that mini bounce on the open. So I can't really give you any more information than that right now because this is a day to really evaluate. There are going to be some opportunities on the short side, but on an early sell-off like this, the risk of having this thing fly back in your face is just not worth it unless you find some real gems in there. And I'm trying to think of whether or not I even want to set you up with a trade. I don't know how the market's going to open today. I don't know what the stocks are going to do. I only know that a lot of them have dropped dramatically. So I think I'm going to just leave it at that this morning. Heads will prevail. All we need to do is watch the price action. Today, I would be relatively inactive. I'm going to do a video before the open tomorrow. It's going to be shorter. This is a monster market move, and that's why I thought I would get this out there a little bit earlier. So the only thing I would be doing today is I'd be taking profits on my short positions, and I would not be looking to aggressively get short on this move lower, although I do believe we're going to open low and we're going to continue to slip very gradually. And within the first 90 minutes of trading, we're probably going to see the extent of the move lower, and then we're going to flatline. Friday, I believe we're going to see a little bit of movement back and forth, but in general, it's going to be a day of rest, and it will probably finish somewhere in the range that we established today. So it'll be an inside day, and then everybody will scratch their head over the weekend and go, now what? So don't do anything rash. Don't make any big decisions, any big trading decisions today. Our opportunities for the next few months are going to come on wimpy little bounces. when we can short when that bounce runs out of steam. That is your focus. And if that's your only focus, you may not trade for a month or two. But hallelujah, when it's time to trade, you're going to make a shit ton of money. So be patient and wait for those failed bounces. That is what you need to do. Trade well, everybody. Be careful. Don't make any big decisions. Don't try and be a hero today. Watch the price action. Based on what we see today, we'll know where the market's going next. We'll see you soon.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.